Hello everyone. Now we'll start a discussion on chapter number 74 of liquidity risk managing and pricing of deposit services. So banks primarily have two sources. The primary source is the deposit services. Deposit services meaning the customers deposit their money in the bank and the same money is used for the lending purpose. So we have to make sure all these deposits are priced or charged in certain manner so that the bank can generate returns from it. So say deposits, bank pay interest on these deposits at say 5% and provides a loan to their customers at say 10%. So there is a margin of 5%. So this is the general idea of deposit services. So deposit services are used in the various forms in India. If you just consider the Indian form of deposit services, then we can say it is a savings, current account, term deposit, which is a fixed deposit account, and so on. So all these are the deposit account. Now, when bank is unable to fulfill their loan requirements or the loan demands using these sources, bank goes to the next source, which is the non-deposit service or the non-deposit sources. So non-deposit sources are primarily the loans. They have different options to borrow. Banks have different options to borrow loans from the various entities. This discussion is covered in the next chapter, chapter number 75, which talks about the non-deposit funding sources. Okay, so both the chapters have similar structure. We will talk about the various account types in the deposit services, and in non-deposit chapter number 75, we will talk about the various entities who provides various types of loans which can be used for the lending purpose. So that's the basic difference between the two chapter. And with this, we also have the discussion which relates to the pricing of the deposit in the deposit chapter, that is 74. In 75, we have how to consider the prices of non-deposit sources in the next chapter. In this chapter, the first section is very easy, where we are talking about some basic features of the accounts which you already know. Okay, if you know basic banking, you already know all these types of accounts. My concern is the pricing of these deposits. So here I will provide you two files. The first file is for the summary notes of this chapter. So I reduce 15 pages of complete chapter to 3 pages. This covers each and every important point. So you are supposed to remember by yourself. I will just give the quick overview of everything here. And with this, I will also add one illustration file. Okay, so this is your illustration file. You will get the same file in your folder. Now, when you use illustration file, make sure specifically this particular point, which is a marginal cost method part, you study from here instead of your book. This part is not very well explained in your book, so make sure you study it from here. Okay. So let's start our discussion. The first part covers the transaction and non-transaction deposits. So deposit sources, there are two types of deposit sources: deposit accounts, transaction, non-transaction. Transaction, you can directly relate it to the current account. In the India, we have current account system. So in current account, you deposit money, or the companies deposit money so that they can use it for the to pay off their expenses. Okay, so as I have current account, I will deposit some money so that I can pay salaries and purchase some raw materials and pay for some services like that. So transaction deposit is similar to that. Non-transaction is like the savings account, fixed deposits, like that. Now, terminology which is used here in these chapters is different. Okay, so structure is same, but the terminology used is different. So first is the transaction deposit account. So transaction deposit account is similar to your current account, right? So whenever you are reading this section, you have to just relate your known name for that account with this particular name. Okay, transaction deposit, current account, like that. Non-transaction deposit, savings account. Okay, so this is the thing you are supposed to do. Now, first we will start with the concerns. There are two primary concerns for the banks when they are considering deposit services as a funding source of funding. The first is what are the lowest cost of funding sources available? And second concern is how can the bank raise sufficient deposit to fund the loans and the other activities? Definitely, these are the two concerns, very basic, nothing to explain here. Now, what are these sources? So first we will study sources. In these sources, the information is provided like which one is the cheapest source, which one is expensive, what are the typical problem of different types of accounts and so on, which you can read and understand. So I will move quickly from here. I will not waste your and my time in this discussion, specifically your time, because hardly it will take 10 minutes for you to read. And in case you are not able to understand some parts, just ask me. I will provide you the explanation. No problem with that. Now see here, the transaction deposit. These are the current deposit accounts. Again, as I've already explained you, we will deposit the money there. Yeah. So I'm talking from the perspective of customer, but remember, we are discussing everything here from the perspective of bank, okay, not from the customer. So to explain the accounts nature, I just use the customer side, okay, but keep your focus, assume yourself as a bank. Now see here, this particular transaction deposit account, deposit money, we use it for depositing money and paying off our expenses. So this is the first type of account. Then just read, you will understand like what are the different key points here. I will just give you the idea how to remember the key point or what type of key points are there. So here, remember, in transaction account, withdrawals can happen without notice. Okay, so meaning this can create a liquidity situation. So whenever you are considering a transaction deposit account, your concern should be the withdrawal without notice, right? So this type of points you are supposed to remember, but seeing the text, it is so small or so limited, you can remember everything. Okay, so you don't have to worry about what to remember and what not to remember. 3 pages, these are only 3 pages, not 15 pages, so you can remember each and everything. So uh, both the type of accounts. So these accounts, transaction deposit accounts, provides the bank holder or the account holder these type of services: the payment services, secure place to hold funds, and records of transactions. Again, as we discussed, nothing to explain here. Then we have types of transaction deposits. This is non-interest bearing and the interest bearing. Non-interest bearing, same, very simple. Now we have money market deposit accounts. The only important point you are supposed to remember here is the money market deposit accounts are the unregulated. These are unregulated accounts, and the rate, interest rate, is the money market interest rate. Okay. Then next is the mobile checking account. In mobile checking account, just imagine the mobile banking account, the bank account where you are supposed to or where you are allowed to go with the mobile banking. And then there are the concerns raised like should we still need ATMs and so on? What are the opportunities with the mobile banking and so on? Again, simple to read. The next is the non-transaction account, which is the savings and or thrift deposit accounts. Saving deposit account have the different uh, types here. Now, why do we use the savings account? It is for the savings for the future, so that you can use these savings in the emergency requirement or post retirement and so on. There are different types here. Okay, so first is the passbook saving deposit. You all know what is the passbook saving deposit. You deposit the money. These are the traditional accounts, so on and so on. Then time deposits like the certificate or deposit. Fixed deposit, just remember this fixed deposit and then read this particular section. You'll be able to understand what is the theme here. Then there are 4 variations or the innovations of these accounts are included here. So first is the bump up CD. This is bump up CDs. Okay, where depositors can switch to higher rates if the interest rate rises. This is step up CDs. These this includes like step up CD feature is periodically, this is rates are periodically adjusted upwards. Okay, so if the interest rate is increased after a like certain band, then it will be increased to that limit. Then the liquid CDs, in which you are permitted to or permitted to withdraw some funds without the penalty, like you have MODs in some Indian banks, right? So liquid CDs are like the MODs. It will act like the fixed deposit, but you can also use it as a liquid funds. Then you have the index CDs, which is returns are linked with the stock market. Then the retirement saving deposit, again, nothing to explain here, just read by yourself, you'll be able to understand. Then method of pricing deposits. Now, so first, this part covers how to price the deposits. First part, this particular section is again very theoretical section. Just remember core deposits. So now core deposits are in all the deposit options you have, deposit account options you have. One section is the core deposit, second section is the non-core deposit. Core deposits have the least expensive source of bank deposits, are not highly sensitive to interest rate changes, hence stable source of funding. Example of core deposit is the fixed deposit or the term deposit or savings account. These are the examples of core deposit. Okay, so in savings account, if the interest rate changes, customers are not going to withdraw their money, right? So it has a different purpose. Saving accounts has a different purpose, like they want to save their money. Okay, so this is because of this particular point, core deposits are not interest sensitive and least expensive source of funds. Now, deposit account cost. What are the costs incurred in the deposit account by the bank? So demand deposit accounts are the lowest cost funding for the bank. If you just consider the account, this is the lowest cost funding. Although the management costs are higher because you allow frequent transactions, and low to zero interest cost keeps the overall cost of funding low. Okay, so banker traditionally earn the fee income on the deposit account, offsetting the some overhead cost. Fees have increased in some items like the ATM usage fees. Okay, so in current account, banks are not supposed to pay any interest, but also these are very liquid funds. So here bank's job is to make sure that the expense bank is incurring on providing services to deposit accounts, it should be able to the charges the charges applied on the transaction should be able to cover up these expenses. Okay, so this is the basic theme here. Now, how to price these deposit services? Deposit services pricing. This is the key point here. Okay, this is important area which we are going to discuss here. I'll just quickly read this part. So when the depository institutions were first allowed to pay the interest on the transaction account, many institutions aggressively sought the market shares through below cost pricing. So whatever the cost bank incurring to provide these services, they were charging lesser. Okay. Now because pro, this is providing because providing services cost very higher, depositors earned implicit interest. So like say 0% is fees paid on these deposit accounts, and bank is incurring say 5%. I'm just taking the rough idea, 5% as in the expenses, okay, on the operations, transaction services provided to the customers and so on. So total expense incurred on maintaining these accounts is the 5%. And when bank charges the customer for the transactions they are doing, like say for the fund transfer, for the withdrawal or the deposit and so on, it is say 4%. Okay, so bank is incurring 5% and charged from the customer 4%. So this 1% is implicit interest to the customer. That is, customer is able to save 1% on the transactions. Okay, this is the meaning of the implicit interest here, which resulted in the banks were not allowed to pay. So because of these things, banks were not allowed to pay interest rate on the transaction accounts. As such, only way to pay interest was through implicit interest, like giving gifts to the depositors for the opening accounts. So they gave gifts in the various forms. So this is the one part. Now, this is our important discussion. So here we have different pricing methods. How to price these deposit services? First is the cost plus pricing of deposit services. You will read the details. I will give you the explanation of illustration. Then marginal cost method to set deposit rates, then conditional pricing. Okay, so let's first discuss what is the cost plus pricing of the deposit services. Cost plus as in whatever the bank is incurring, that will be charged from the customer. So cost plus pricing. Unit price charged to the customers for each deposit services. So assume this is the monthly cost charged on the particular deposit. There is a account maintenance charges like this. So whatever the operating expenses plus estimated overhead expenses, like what type of transactions that customer is going to make, based on that you will allocate some overhead expenses, and planned profit margin. So what is the bank's profit margin on the accounts? So here you have example illustration. The cost to service a particular account is say $5 per month per account, of course. Allocated overhead expenses to that particular account is $2, and the profit margin is of $0.5. Calculate the unit price charged to the customer for using cost plus pricing. Using the cost plus pricing. So of course we already know, like, to add operating expenses, overheads, estimated overheads, and planned profit margins. Add these and you will get the answer. See, this is very basic. So you have to just add three values and you'll get the answer. This is as easy like as like a fifth standard mathematics. So you have to like think about like what type of questions you will get on this particular part. I personally think you will not get any question. Most important point is the marginal cost method to set up deposit rates. Okay, this is forward looking approach which considers the marginal cost to bring the one additional dollar of deposit rather than assuming that this historical averages. Okay, I will give the explanation. Now see here. So marginal cost method to set the deposit rates. So what is the marginal cost? Marginal cost is the change in the total cost is equal to new interest rates multiplied by total funds raised at a new rate minus old interest rate multiplied by total funds raised at the old rate. And then marginal cost rate is change in the total cost divided by additional funds raised. So change in the you should be charging change in the total cost, whatever is the change in the total cost of maintaining these accounts divided by additional funds raised. Okay, now here we have very important point, like the decision making of raising new funds based on the marginal cost method or the total cost method. So we have two methods here. So imagine a scenario that you are the new bank, you want to procure funds from the market using the deposit services, say using the savings account where you are supposed to pay some interest. So if you just focus on this table, here you have different options. What is your plan? All the values are in the millions. So what is your plan? To raise $100 million, 200 million, 300 million, or 400 million? If you want to procure 400 million, definitely you should offer some very lucrative interest rate compared to the market, say 7%, so that you get so many depositors who are willing to deposit money in your bank account, right? So if I want to say, if I'm the bank and want to procure $400 million, I have to offer 7%. If I just want to procure $100 million, then I have to just pay 4%. That is, pay lower interest rate, you will get lesser funds. If you pay very high interest rate, then you will be able to get the 400 higher funds. Okay. Now here this table shows you, that is, first expected deposit, that is procure 100 million, 200, 300, or 400 million. To procure these much funds, what is the offered rate? What rate you should offer? 4%, 5%, 6%, and 7%. If you use these rates, what will be your interest cost? Of course, 100 multiplied by 4%. Then 200 multiplied by 5% is the $10 million. So $4 million, $10 million, $18 million, and $28 million. This is simple multiplication. That is the interest cost. Very simple. Now, next, marginal cost of new funds raised. What is the marginal cost? That is, from going 100 to 200, what is the additional cost you are incurring? So for going from 100 to 200, your additional cost incurred is $6 million. From going 200 to 300, your additional cost incurred is $8 million. From going 300 to 400, your additional cost incurred is 10 million, right? This is the marginal cost of raising new funds. It is simply, if you use the previous slab, what was the cost for the new slab? What is the difference between these two? Okay, so this is very simple. Now next, marginal cost of funds raised. Marginal cost as in, this is 4%, 4% on $100 raise. Now for the next, you are incurring $6 million, and how much extra you are able to procure? $100. So $100 to procure additional $100. How much you have to pay in extra? $6, which is 6%. For the next calculation, which is this $300 to 200 to 300, again $100 in denominator, and extra cost you incurred is, this is extra cost, remember. Okay, actual cost is 18 million, extra cost is $8 million. So this will be 8%, and in same fashion you can do the calculation for the 300 to 400 and you will get the answer. The marginal cost of raising new funds is the $10 million. Okay, so extra funds procured $100, and for procuring extra $100 you have to pay $10 as an extra cost. So marginal cost of raising funds. Now imagine a scenario, you can lend money at 7%. So your lending rate is 7%. So if you just take the deposit at 4% and provide loans at 7%, so 4 minus 7 minus 4 is your interest earning, right? You can go by the same methodology for the next value, which is the 5%. So 7 minus 5, 2% is your extra, 2% is your earning, return on income, return on investment. And then 6%, so if you go with the $300 procurement and you pay 6%, so still you are in the positive return. So 7% minus 6%, right? But when it comes to $400, you are producing losses. If you just see from this particular angle, you will find which should be your cutoff point, how much fund you should procure. It should be 6%. But remember one thing, this, if you apply the marginal cost method, marginal cost as in when you procure new funds, that is, if you want to procure additional funds, for procuring additional funds you have to pay some extra cost. When you pay extra cost, maybe it is not in your favor. So see what happens. This is your marginal cost, 4%, 6%, 8% and 10%. You can see here, if you are able to lend at 7% and if you are incurring margin cost of 8%, you are producing losses. Losses of 8%, 1% on, that is 8% minus 7%. Okay, so see here, I'll explain you what happens in this particular scenario. So should you raise the new funds? So first answer, if you go by the marginal cost method, the marginal cost of funds, which is 8% here, is higher for raising 300 than the return on investment ROI. Hence, the bank should not opt for raising additional funds. If you go by the marginal cost method, bank should not opt for the additional funds. Then, if you go by the dollar value method, cost of fund, which is 6% here, this is the cost of fund for raising $300, is lower than your return on investment, which is 7%. Hence, banks should raise the new funds. So these are the two different approaches. Which one is the correct approach? Correct approach is the marginal cost method. Why? See here. In exam, you have to see for the question. For the discussion purpose, I am telling you like which one is the correct method and which one is not correct method. Now see here. Return produced at 7%. So say you have $100. If you lend at 7%, then you will earn 7. If you lend at 7% and the amount is 200 million, then you will produce returns of 14 million, then 21 million and 28 million. Say 20, that is 7% on 400 million. So 7% on 400 million is the 28 million. So you are able to produce returns, but we also have to look for the cost you are incurring. So if you just look for the cost in the form of 7% multiplied by 400, then you will find that you are incurring the cost of 28 million and you are producing returns of 28, which is net gain on the dollar using the dollar method is 0. Okay, if you consider the previous illustration or the previous example, here you are procuring 300. So total interest paid to procure 300, 18 million. Total interest earned by lending 300 million is 21 million. So 21, 18. Difference is 3. You are still able to produce the positive returns, but 3. Now see here. If you just procure 200, total interest, sorry, total interest paid is 10 and return produced on this particular funds like 200 is 14, meaning net gain of 4, right? And if you again go back like the 100, if you go back to 100, then your gain is 3. So which one is the best option? 4, meaning which is the raising $200 million where you have the gain of 4. So meaning our marginal cost method is very appropriate, which tells us like if you move to this particular part, like if you move forward, if your lending rate is below the marginal cost of funds, you will start producing losses, which you can directly see here. So your gain is reducing from 4 to 3. So if you're concerned with the net profit, then you should go for this particular. Okay. If your concern is expanding a customer base, where like the customer base is in those who are procuring funds from you, then you should go for the 300 because it is able to produce the positive returns 3, right? Then definitely 400 is not the option because it will not produce any returns. So this is this scenario here. You are supposed to remember how this works. If you want to see which is your whatever is the cutoff point, the correct cutoff point for choosing the optimal solution of procurement is go by the then you have to go by the marginal cost method. Always make sure that your lending rate is higher than your marginal cost. In that situation, when your lending rate is higher than the marginal cost, then you will produce positive returns, that is a higher income. Okay, if equation is reversed, like in this case, if your lending rate, which is 7%, goes below your marginal cost method, then you will start generating losses and soon you will end up generating losses. Okay, so this is about the marginal cost method. Then you have conditional pricing. Conditional pricing is very simple. Okay, conditional pricing is pricing depending on the various situations. These situations can be anything. There are few illustrations given here. So flat rate pricing where you charge fees. Say example is fees charged on the ATM usage, which is applicable in India as well. Then free pricing as in no fees is charged on the accounts, but interest paid is very low. Interest paid as in interest paid on that saving account is very low. Then conditionally free pricing. So you will look for the customer base. If you think that particular customer will give you a lot of business, then you will charge lesser transaction cost from him. Okay, and using this you will be able to produce nice business, nice revenue. So this is the meaning here, conditionally free pricing. So bank can also go for the engage in the relationship pricing when the bank prices deposit services in conjunction with all the other services of the customers. Okay. Now see, I'll just also read the conditionally free pricing here. Customers chooses an account in which small deposit accounts may have fees associated with them while the large deposit accounts are free. So I by mistake use the different explanation for the conditional pricing. Conditional pricing as in that for different account, different pricing like this. Okay. And the next part is the this particular part. You also have the option to engage in the different pricing, the conditional pricing, where depending on the customer, type of customer, you will decide the prices. Okay. Now the challenges faced by the banks that offer deposit accounts. So first is the deposit insurance. Deposit insurance. So FDIC insures the deposits in the US. So there are few norms for these coverages or the deposit insurance. Read from illustration. Okay. Then FDIC insurance premium. So if the institution is riskier, of course higher insurance will be charged. If the that insurance institution is less riskier, then less premium will be charged, and like that. So this is a very common sense thing you can read and understand. Then bank disclosure. So banks are required to make a greater disclosure of the terms of deposit account. So what type of disclosures are required? So minimum balance to open the account, minimum balance to maintain the account, amount maintenance to earn the promised yield, how the balance is calculated quarterly, half yearly, daily, annually, like that. And the annual percentage of the yield must be disclosed. So APY, there is a formula. You already know, your masters of interest rate in FRM Part II, right? So you already know how to calculate the yield. So this is very basic calculation. Then overdraft protection. So in OD account, if you overdraft the money, then you are charged some penalty. Okay. So in this part, you have to see like there are services which protects the customer from overdraft penalty. It's very simple. And then read the basic part, which is very easy. And then you have the basic lifeline banking. Before we begin the basic lifeline banking, I have to we will just discuss this particular part, the deposit insurance services. So as per the FDIC, current deposit coverage is $250,000, okay, per account holder. So there are two important scenarios we are supposed to discuss. So in one particular bank, if you deposit say $5,000, if that bank collapses, as per the insurance terms, you will get $250,000. Okay. So here you have two special scenarios, and remember this is applicable only when the bank fails. This is not applicable for if your amount is if your like the funds are stolen, or if your cash is stolen, like that. Okay, it is not applicable in case of theft. It is only applicable in case of bank defaults. Okay, now there are two important scenarios. So say you have two banks, bank 1, bank 2. So in bank 1 you have some funds, in bank 2 you have some funds. So in every bank you will get $250, because this is per bank basis. So $250,000 is per account holder per bank. So if you are holding in say 5 different banks, if you are depositing funds in the 5 different banks, then you will get the advantage of 250,000 multiplied by 5 for every bank. Here we will take the example of two banks. If these two banks merge with each other, then this amount will be clubbed and you will only get the benefit of 250,000, because per bank, per account holder, right? So when the bank is merged, automatically your accounts will also get merged, and because of this you will get insurance which is limited up to $250,000 in case of the merger. This is you are supposed to remember. And pre-merger, what was your coverage, insurance coverage? It was 500,000. This is pre-merger. Okay. Now next is the when the account holder holds two accounts as a different legal entity, meaning, say you and your wife, you have two independent accounts in the same bank, and then you also have one particular joint account in that bank. So your account, your wife's account, and a joint account, these are three different legal entities. In Indian perspective, if you want to just discuss, say your wife, you, HUF, Hindu Undivided Family Account. Okay, so if you are holding say three accounts and then say fourth account, which is the joint account. Okay, then you have the four different legal entity. HUF is a different legal entity, so you have four different bank accounts. So if that account holder is holding three or four different accounts as a different legal entity, then every individual account will be considered as a separate account because it is different legal entity. Okay, and example is say joint account versus individual account. As we discussed, like you and your wife is holding two different accounts plus one joint account, so you will get three accounts, and your insurance coverage in that bank is dollar 750,000, right? Next, here you have in your book, you have list of two things. One, FDIC insurance covered list, like these are the accounts in which the FDIC provides the insurance, and then you have list of FDI insurance does not cover list. Okay, so the list of accounts which are covered by the FDIC insurance is very big. So I recommend you to just read this particular part, like what is not covered. So what is not covered? Government security is not covered, mutual fund shares not covered, safe deposit box content not covered. That is, we talked about, like if your content, if your those safe deposit boxes or the some content in that those safe deposit boxes is stolen, it is not covered. Funds stolen from the insurance deposit institution, insured institution, it is not covered because it is stolen, and the rule or the insurance is applicable only for what? It is only applicable in case of the bank fails and the business account. Okay, then note, if the business is under proprietorship, benefits are per as per individual basis. So if you have any proprietor's account in that bank, then you will get the benefit of the individual account. Meaning, if you have say proprietor account one, and then you have your individual account. So remember, proprietor is not the different legal entity compared to the individual. So both will be treated as one, and you will get the benefit of only $250,000, not more than this. So this you are supposed to remember here. Okay, now we will come to our previous, like this main sheet. So basic of lifeline banking. Again, you can read it by yourself. I'll just give you a quick overview of the lifeline banking. So lifeline banking is in India we have Jan Dhan Yojana, right? So access to banking system for every individual, every poor, rich, or every individual. So this is about the basic lifeline banking, or the you can say basic banking or lifeline banking. So Jan Dhan Yojana or Jan Dhan Khata, that is Jan Dhan account, is for basic banking, where you provide banking services to poor, where no fees is charged, no minimum balance is applicable, and so on. So this is that government's or that country's social responsibility. And here we are talking about the social responsibility. Primary concerns for this social responsibility is who will bear these costs. Should the government bear the cost of basic or lifeline banking, or the bank should bear this cost, or bank should charge their premium customers these particular costs, and so on. So this is the point you're supposed to remember here. So that's it. So this is about the lifeline banking. You're supposed to read everything, this particular sheet, and you're good to go. Okay, so thank you very much. Thank you for listening. See you in the next chapter.